Welcome back to Ben's Book Club. Today we are diving into the book Get Started Investing. It's easier than you think to invest in shares. The authors Alec, Renehan, and Bryce Leske, they built this massive audience by proving something really important, that the stock market isn't some walled garden reserved just for Wall Street insiders. It's actually highly accessible to absolute beginners. You don't need a finance degree, you don't need hours of free time, and you definitely don't need thousands of dollars to get going. So, what's actually keeping you sidelined? Is it all that confusing financial jargon that just makes your eyes glaze over? Or maybe it's the very real fear of losing your hard-earned cash in a market crash. For a lot of folks, it's just this persistent myth that you already need to be wealthy just to buy your first stock. Well, if any of that resonates with you, trust me, you are far from alone. But let's think about this completely counterintuitive problem for a second. Leaving your money just sitting idly in a standard savings account. It actually guarantees a loss over time. Crazy, right? But it's true because of the silent threat of inflation. It just slowly eats away at your purchasing power year after year. So playing it totally safe by hoarding cash under the mattress is actually one of the riskiest financial moves you can make for your future. Making the necessary psychological shift means we have to move from a saver mentality over to an owner mentality. As a saver, yeah, you might be successfully putting money away, but you remain incredibly vulnerable to lifestyle creep. Spending more as your salary goes up without ever actually building wealth. But when you shift to being an owner, that dynamic flips entirely. Your money actually starts working for you. And this mindset completely busts through all that confusing market jargon. Think about it. What is a share, really? It isn't just treating abstract pieces of paper on a flashing computer screen. Buying a share means you are buying a tiny fractional ownership slice of a real, breathing company. When you buy a share, you're essentially hiring the world's best CEOs and teams. We're talking folks at Apple or Amazon to wake up every single day and work to grow your wealth. Okay, so once you own that slice of a business, how does it actually put money in your pocket? Well, it happens in two primary ways. First up is capital growth. The business grows, it becomes more valuable, and boom, the price of your share goes up. The second way is through dividends. A lot of profitable companies will regularly take a portion of their earnings and distribute it directly back to you, the shareholder. Now, you might be thinking, wait, what about the massive risks? Well, one of the authors, Alec, shares a super fascinating and pretty painful cautionary anecdote in the explainer. Early on in his investing journey, he lost 99% of his money on a speculative hot tip about a single company. 99%. It's a staggering number, and it perfectly highlights why treating the stock market like a casino, chasing fast money and rumors, almost always ends in failure. To avoid those kinds of catastrophic losses, investors generally adopt specific strategies. You'll probably hear about value investors who are out there hunting for cheap companies, or growth investors looking for rapid expansion. Then you've got momentum traders following market trends. But look, if you're just starting out, spending your time reading balance sheets and analyzing trends probably sounds exhausting. Fortunately, there's a much simpler, way less stressful, and highly effective route. If you don't want to spend your days researching individual stocks or stressing over market reports, how do you get involved? How can you get instant diversification, which just means spreading your risk across a bunch of different assets, without needing a massive fortune to start? The answer is an ETF, or exchange-traded fund. Let's translate this into an everyday analogy. Imagine walking into a supermarket, and instead of buying individual ingredients one by one, you just grab a prepackaged basket that contains a tiny slice of everything you need. That's an ETF. It does all the heavy lifting for you. In a single transaction, it instantly spreads your money across hundreds of the top global companies. It's basically instant diversification in a box. When you break it down like that, the choice for beginners is incredibly clear. Active stock picking, it's high stress and high risk. You've got to constantly monitor the news, decide exactly when to buy and sell, and somehow try to beat the market. Passive ETF investing, on the other hand, is automated and super low effort. You literally just let the fund track a broad market index. It gives you exposure to global growth while you just get on with your life. If you're sitting there wondering if this keep it simple ETF-first strategy is a little too good to be true, consider this number. The authors didn't just invent this approach in a vacuum. They actually validated it by consulting with over 150 expert investors. The overwhelming consensus from the pros? Complexity is the enemy of execution. Keeping it simple is absolutely the smartest way to build scalable wealth over the long term. This whole approach relies on the absolute most important behavioral psychology you need to succeed. Time in the market beats timing the market. You cannot predict what the stock market is going to do tomorrow, next week, or even next year. But history clearly shows us that patience and long-term compounding are a beginner's greatest assets. You don't need perfect timing. You just need to start the clock and let the market do the work. Now, obviously, you will experience drops. Market dips are completely normal and an inevitable part of investing. The trap that catches so many new investors is emotional panic selling the second they see red on their screens. The book warns strongly against checking your portfolio too frequently. If you've invested in broad ETFs with a long-term horizon, you really just have to learn to ignore the daily noise and trust the process. Taking the plunge requires a highly accessible blueprint, and it goes like this. Step 1. Build basic financial stability. Pay off high-interest debt and have an emergency fund. Step 2. Pick an online broker or platform. Step 3, start small. Thanks to modern micro-investing apps, you can literally start with your spare change. And finally, step 4, automate your contributions. Just set up recurring transfers so your investing happens effortlessly without you ever having to rely on your own willpower. The barrier to entry has literally never been lower. You don't need to be an expert, and you definitely don't need to be rich. You just need to start. So, what will your very first step be today? Even if it's just setting up a brokerage account or transferring $10, the key is to stop waiting on the sidelines and start acting like an owner. Take that step and subscribe so you don't miss an episode.